Test, test, 1, 2, 3. What's going on, team? It's Ricky with Learn Plan Profit. Hope that you guys are all having a great start to your morning. Alrighty. We got Tesla dropping. Looks like we're testing that pre-market support right around 250 flat. This is a pretty common support range that we had yesterday, looking at oversold levels. So just let's look and be aware of previous patterns. Oh, wow, extreme volatility. This is wild. Look at that. Tesla trying to go back into the green. There we go. Good morning, good morning. If you guys can hear me and see me okay, let me know in that live chat, please. Wow, look at that. Holy smokes. A full $1 per share in less than 10 seconds. We got NASDAQ market already showing signs of a slight resistance. No. There it goes, getting filled. NASDAQ market pushing. All right, testing same support. Holy smokes. Look at that. Holy smokes. What an absolute joke. Ripping higher for longer. There it goes, break even. NASDAQ market correcting itself already. Strong pullback on NASDAQ. What in the world, bro? Crazy. Crazy, crazy, crazy moves. Look at that. It's still trying to run. Let's see if we get it. What an absolute joke. For no apparent reason. We'll just keep adding more to it. Oh my goodness. Look at that. NASDAQ market going higher for longer. NASDAQ market about to break $500 for the first time for QQQ. Wow. He doesn't speak until 30 minutes. Crazy, crazy, crazy. I literally can't wait until the market crashes. And there it goes. Huge pullback. Again, it's all just a bunch of manipulation. All just a bunch of hype, bunch of manipulation, runs it all the way up. Very short-lived catalyst. And here it goes, correcting itself. Same thing happening with Tesla. Come on, Tesla, come back to where you belong. $150 per share. Ricky, are you not limited to 3-day trades within the PDT rule? If you're under the PDT rule, yes. That means that you trade with less than $25,000. If you're asking if I'm under the PDT rule, then the answer is no. I do not trade with less than $25,000. You should know that if you've taken time to watch the course or even see in the Discord chat where I talk about my trading profile. Here it goes. Tesla's still trying to test. This is so ridiculous. So dumb. For what? All right, here we go. Here comes the drop. Glad we were able to add a little bit to it when it became overbought for a nice little short. Here comes the progress. Come on, come on, come on. Wow, we are not making lower lows. NASDAQ market is selling off way better than Tesla itself. Look at that. Strong pullback. It is consolidating, so it is testing, its support range here for sure. Oh, there it goes. Tesla beginning to curl over. Beautiful. Beautiful reversal forming on Tesla. Right? It's an overbought reversal. It gapped up very quickly within a short period of time, became not only just overbought based off of the RSI and the MACD indicator, but just looking at the price action, it began to consolidate, lack progress beyond a specific range, and then that's when we can get confirmation of, okay, is it showing signs of progress on the downside? So let's see. Tesla's been a stubborn stock for the past 3 to 4 weeks as it's been trying to justify any and every reason on why it should continue to hold up here. We'll see if it does, right? NASDAQ market has already pulled on back to where it was before that ridiculous push. All right, my take profits will be right around the moving average. So right around 250, 150 is where I want to aim towards closing. Let's see if we get it. It is showing signs of a support here, so it means that it could go back to retest. And there it goes. Any and every reason on why to go up. You gotta love Tesla. Look at that. NASDAQ market actively pulling back now further than what it was. Love to see it. It is still testing same general support range. So let's just be cautious of that, okay? Did you guys hear the news overnight? I think it was a Delta airline plane, right? And it was a Delta airline, but then it was a Boeing plane that took off from Los Angeles. Is that correct? Yeah. United Airlines. United Airlines Boeing jet loses wheel after takeoff from Los Angeles, lands safely in Denver. Holy smokes. I just looked at Tesla. My bad. Look at that. Dude. I mean, you can't make this stuff up. This thing is trying to find any reason to move up. Oh my God, dude. It's so frustrating. So much BS in one stock. Yeah, so it's United Airlines, which should be this. Looks like it wasn't really too affected by that. Yeah. Looks good. Looks fine. Holy smokes. For what? Why pretend to run when you're going to correct yourself? A lot of people are seeing Tesla going to 300. There's a lot of people that also don't justify the 40% run that it's had already. It doesn't matter what people assume or what people think. Anything's possible, right? And it was right into the close also that it tried to gap up very quickly before market ended up closing, which is ridiculous. Just like the NASDAQ market. The NASDAQ market was oversold, probably going to close in the red. and then ran back up and had to close in the green. Manipulation, gotta love it. And really slow progress on either side. Nvidia is up another 3%. Nice little reversal forming. I'm sure Nancy Pelosi's happy about that. Going back up to previous highs. Wow, still holding its ground. Okay. Just a stubborn market. Tesla's beginning to, Microsoft is beginning to peak and curl back over. So we'll possibly begin to see some retracement here for Microsoft. Thought Apple was showing the same sign, but looks like it's already trying to bounce. Right, lacking progress, pulling back to the EMA. If we break below that, pulling back to the moving average. Amazon still looks like it's in the green, but trading sideways. It's been lacking progress ever since it hit highs of $200 per share. Can't be surprised for a potential pullback at these overbought levels. I don't care about this stock. I don't care about Visa. Alright. And we have Nike. Nike has been looking quite attractive lately. But the biggest... I'm probably going to make a video about Nike pretty soon because of how much it's sold off. It's at previous levels of... Was it 2021, 2002, or 2020 possibly? So if we go back... Yeah. Oh, yeah. It's at 2019 levels, 2020 levels. Yep. So really nice pullback here. And we'll begin to see if we begin to trade sideways or begin to show signs of a potential support. That would be a good sign for, just maybe some ground to potentially begin to recover. But definitely something that I want to watch. Not sure if I want to buy it just yet. Tesla pulling back. Yeah, barely, right? Yeah, it's still at 254. I need Tesla to be down at 250. Look at that. It takes 10 minutes for it to sell off, 2 minutes for it to recover. Love it, love it, love it. Look at that. SMCI reaching overbought levels. Nvidia still pushing up though, so let's be careful. DraftKings trying to form a reversal here. You guys see that? Just like when it sold off, it tried to find its support and then run up. This is a descending pattern, so something to take into consideration, but sold off, trying to establish a support, and then we'll see if that price action follows in favor of DraftKings. Okay. Hood trading sideways, coin trading sideways. That's all due to Bitcoin lack of progress. NASDAQ market pulling on back. Man, how is it that we are getting NASDAQ to pull on back, but nothing else? How did your trade go yesterday? I finished strong. If you guys were keeping up to date under trade ideas, I posted every update on every trade I took. And with the series of short positions that I've had on Tesla, my last short I quickly covered. And I took profits a little bit earlier than what I expected, which if you look back at Tesla, I had a nice little pullback right into the market close. I took profits right away, right around 250, and it quickly began to recover. So ended up doing like 4K. I think it was like 4.2K on the day. So I spent most of my day yesterday filming LPP 3.0. So right after those series of trades, we just got right into filming, and we filmed for about 4 hours. So I have a lot of filming to do today, tomorrow, and for the next 2 weeks. Dude. What in the world? Oh my goodness. What a joke. What's going to be the biggest difference between LPP 2.0 and 3.0? Once I have updates for you, I'll let you know. Okay? All right, we have 6 minutes left until Jerome Powell begins to speak. Oh, God. I'm not a fan of these people. NASDAQ market is beginning to push higher for longer. Look at that. Oh, how we love it. Three minutes left. There he goes. NASDAQ running higher for longer. Testing same previous resistance. We got 2 minutes left until Jerome Powell begins to testify in front of Congress. Excuse me. I'm allergic to hype. Thank you, thank you. All right, testing same resistance. Wow. Yep, running higher for longer. Everything. Look at everything push. What a joke. Everything's pushing. Nvidia, QQQ, Tesla, and watch them all run back down. Just a bunch of manipulation to trap a bunch of hopeful people. Are you streaming it, mate? Yeah, is that cool with you guys? Or do you guys want me to close out the live stream and you guys can watch it on your own? What would you prefer? Here it goes. All of this just to waste time, right? Know when to take profits. Can't stress that enough. Look at this. What an absolute joke. It's a circus. Alrighty. I wonder if I could change the name and make it public while I'm still streaming. Let me try. Here it goes, ripping back up. Of course, why not? All right. I feel like I just made it public. We'll see if it... Man, they still haven't started.
Senate Committee on Banking, Housing, and Urban Affairs will come to order.
Jesus Christ.
Welcome, Jerome Powell. Nice to have you back.
This guy needs to
first this time of year.
This guy needs to stop smoking.
Americans know that our economy fundamentally is not a fair playing field. Instead, we have a David and Goliath economy where the largest corporations use their power to funnel all the gains in the economy to the top, aided and abetted by too many people in this room. Corporations squeeze every last penny from Americans' pocketbooks and workers' paychecks. They don't even try to hide it anymore. The biggest corporations are charging more for less.
Can you guys hear it okay?
Americans are frustrated. No, actually, Americans are pissed off. They have fewer and fewer choices. Those choices cost more and more. Keeping prices down is part of the Fed's mandate, but as many of us have made clear, the Fed's main tool to combat inflation, raising interest rates, does nothing to address the biggest causes of rising prices right now, corporate greed. Keeping rates too high for too long threatens workers' paychecks while keeping other costs high, particularly housing costs. Housing prices and rents continue to go up. It's no surprise that since the Fed began raising rates, the amount of income families need to qualify for a mortgage has nearly doubled. Home ownership has long been a bedrock of our middle class, but today fewer and fewer middle class families can afford to buy a home.
NASDAQ market
higher interest rates
back.
are making our country's housing supply shortage worse, not better. We need more housing construction of all types.
What did we say?
Higher rates lead to the opposite, and particularly make it harder for multifamily construction to work financially. Higher interest rates make borrowing more expensive for working families, whether it's for a mortgage or a car or anything else. Most people don't have the luxury of paying for everything in cash. And for the millions of Americans feeling their budgets stretched by higher prices, taking on credit card debt to pay for groceries and other essentials has become an option of last resort. But as more people struggle to pay down their debts, credit card interest rates are reaching all-time highs. Last month, Director Chopra testified in front of this committee and explicitly stated that credit card issuers are charging higher rates far beyond what they need to cover their costs. Corporate greed rearing its head again. Banks are making record profits at the expense of cash-strapped Americans. Every month that the Fed keeps rates high, Mr. Chair, it costs Americans money by making it more expensive to buy a house and to borrow money. Higher borrowing costs stifle future economic growth, leading to fewer homes being built, leading to businesses making fewer investments in the economy, and eventually, if the Fed doesn't stop, leading to workers losing their jobs. As they set economic policy, I urge the Fed to weigh these trade-offs and remember whose jobs and futures are at stake. It's why I've worked with my colleagues to hold corporations accountable and will continue to do that. For instance, we fought to cap insulin prices for senior citizens. We'll continue to fight to extend this price cap on life-saving drugs for all Americans. And why my colleagues and I on this committee are working, it's why we're working to lower housing costs for more Americans. The Fed also continues its work to keep the banking system stable and ensure consumers' money is safe. Last year, the Fed and other bank regulators issued a proposal to update bank capital requirements, strong capital standards, and you've heard in this committee overwhelming support for strong capital standards. They're critical for the economy. It's our way of making sure that if Wall Street bets go poorly, which they often do, investors, executives, and shareholders should pay for it, not taxpayers. The biggest banks have spent obscene amounts of money attacking this Fed proposal. But you, the Fed, don't work for big banks. You work for the American people. Your concern should be developing capital rules that protect Americans' money, not protect bank CEOs' stock portfolios. The Fed needs to look past these shameless lobbying efforts and finalize a rule in the best interest of taxpayers. Another dangerous piece of the Wall Street business model that makes our banking system less safe is incentive-based compensation. This compensation model rewards risky behavior that enriches Wall Street executives in the short term, but makes banks more likely to fail. We saw the results of that model in 2008. We saw it again last year with the failure of Silicon Valley Bank and Signature. Other regulators have moved forward with a proposal to rein in these reckless incentives, but the rule, Mr. Chair, can't move forward without your and the Fed's moving on it. This rule is long overdue. The Fed must join this statutorily required effort as soon as possible. The Fed also has the important job of reviewing mergers and acquisitions between and among banks. Over the last several decades, we've seen the largest banks grow into massive, literally trillion-dollar companies, while thousands of small banks in rural communities in Northwest and Southeast Ohio, in small towns in those areas and all across America have disappeared. Consumers have lost trusted local banks. Small businesses have lost longtime reliable banking partners. Regulators like the Fed have the crucial job of guarding against mergers that reduce or eliminate competition and lead to bank closures or layoffs. I recently sent comment letters to the OCC and the FDIC on their current efforts. I expect the Fed to take the proper steps to ensure that its merger review process is robust and that it protects consumers and communities. Finally, Mr. Chair, you must ensure the Fed has high ethical standards. Fed officials should never again be able to profit from their positions by using confidential plans about Fed monetary policy and emergency programs to pad their investment portfolios. The board's latest update to its trading rules is simply not good enough. It still fails to establish the clear penalties needed for Federal Reserve officials who make investments in violation of the public trust. A rule with no consequences is really not much of a rule at all. The American people need to be able to trust that the Federal Reserve works for them in a time of deep cynicism that people have about the federal government overall. The American people need to know that officials aren't abusing their positions for personal gain. As chair, you have an important role to play to make sure our economy works for everyone, not just for Wall Street. The Fed's regional banks must do their part to hear from people and other stakeholders in their 12 districts to understand their needs. I look forward to hearing today how the Fed will balance its dual mandate, how it will protect Americans' money, how it will foster an economy that upholds the dignity of work. Senator Scott.
Thank you, Mr. Chairman. Thank you, Chair Powell, for being with us this morning. Welcome back. Joe Biden broke this economy, and it's been very difficult to fix it. That's the bottom line. I want to start with the end in mind. Joe Biden broke our economy, and it is very difficult for anyone to fix it. Everyday families are struggling to put food on the table. Real wage growth is being eaten away by rising prices and runaway inflation.
just hit 500.
Think about the fact that for 52 consecutive weeks under Joe Biden, wages were eclipsed by inflation for 52 consecutive paychecks. I remember back in December 2020, in South Carolina, gas was $1.99 per gallon. Today, it's still $3.19 per gallon, a 50% increase in just a few years. So it's devastating to the average American family, particularly families like the one I grew up in, a single parent household mired in poverty. When you see your gas prices up 50%, your food up 30%, your cost of keeping your house cool or warm up 25%, it's not a challenge. It's not unfortunate. It's an absolute crisis. And too many households in America today are living paycheck to paycheck, and they fear the challenges that are coming our way, the headwinds brought to us by the Biden administration. Those headwinds, of course, are seen through the prism of inflation. Inflation hasn't been this high since the Jimmy Carter years, and that devastation is being felt and measured in households by too much month at the end of the money. And that devastation is real for the vast majority of Americans. And the pointing finger, I tell you what, whether it's the Biden administration throwing the Fed under the bus or any other way they can deflect from the real problem. I've seen it, committee hearing after committee hearing after committee hearing. My friends on the left want to point their fingers at anyone other than the real culprits at 1600 Pennsylvania Avenue. The progressive wish list, spending projects, and out-of-control regulations of this administration continues to eat away at American paychecks. And they continue to blame, whether it's shrinkflation, greedflation, skipflation. They're looking for someone to blame except for Bidenflation. The devastation of Joe Biden's economic policy continues to impact everyday Americans. The American people see through the facades and they want real solutions. It doesn't take a PhD economist to understand what the average American is experiencing under this administration. When President Biden and my Democratic colleagues pump trillions of dollars into our economy, those dollars increase the demand and pushes prices higher. It's that simple. The American people see and feel it every single time. When they see it, as I said earlier, the grocery stores, the gas stations, at the doctor's office. It's just undeniable the impact that this is happening. Just last week, we celebrated the birth of our country, the birth of this notion of freedom and liberty. But American families got slapped with the most expensive July 4th on record, with a cookout this year costing, on average, 30% more than it did just a few years ago. I call that hogwash. What's worse is that this administration doesn't want to learn a lesson in economics. Instead of reducing the push for more spending and more regulations, they only simply double down. Let's take, for example, the tens of billions of dollars of student loan forgiveness. Constant new plans to forgive more money, regardless of the constitutionality of their decisions. So it's important to ask, who are these billions of dollars of forgiveness actually benefiting? Well, the answer is simple. This forgiveness scheme will result in debt relief for 750,000 individuals from households with an average income of $300,000 or more. And just don't forget the fact that the average American family has a household income around $74,000. So what we're doing with this unconstitutional student loan forgiveness is actually asking the median household of $74,000 per household to bear the burden of forgiving debt for students who live in households of over $300,000. And the actual cost of this, somewhere between 870 and $1 billion and $1.4 trillion. So why do I have to even ask the question? Why do we continue to punish American families struggling paycheck to paycheck with a new scheme to relieve households over $300,000 of student loan debt? Well, the answer is pretty simple. Politics. It's one way to buy vote after vote after vote for November's election. It's just hard to imagine. So while I appreciate your measured words outlining the Fed's work to cool inflation, I think it's past time we all recognize what is truly going on. Political pandering from the left. I strongly believe that our economy cannot handle any more of this wasteful spending. And if you disagree, I would love to hear your thoughts on that. But it's not just spending policies that stifle growth, it's also overregulation. And I can't think of a better example of overregulation than parking more capital on the sidelines through Basel III endgame. That proposal itself would cost millions of Americans their chance to own a home, start a small business, and have access to the credit and the capital necessary to make their American dreams come true. For those who are actually watching this hearing today on C-SPAN, Basel III capital requirements are like taking your star quarterback, Dak Prescott, and telling him to sit on the sidelines because he just might get injured during the season. It's just plain ridiculous. But these proposed capital requirements would just do that, forcing more money to the sidelines of the greatest economy on the planet and out of the hands of first-time home buyers, business owners, and folks trying to achieve the American dream. The stakes are high, and that is why we have to get this right. You've heard me say this a number of times, but it bears repeating. We need transparency in your rulemaking process, as this enormous proposal lacks any form of clear justification. Chairman Powell, it is essential that you and your fellow governors and the other agencies join in this rulemaking, follow the law, do the homework, and then let the public check the work. And that's why I believe that it is absolutely necessary to have a complete re-proposal of Basel III endgame. Give the stakeholders an opportunity to take a look at it and then recalibrate what is necessary going forward. Any increases in capital that are not quantitatively justified harm the American people who need it most. Our farmers, home buyers, small business owners need and deserve access to credit. Therefore, I'll repeat it one more time. You need to restore confidence in this rulemaking process, pull the existing proposal, and have a complete restart. And then, when the data has been analyzed and is available for the public scrutiny, reissue an appropriate proposed rule following the requirements of the APA. I look forward to your opening statement and having a chance to have a conversation afterwards.
Thanks, Senator Scott. Mr. Chair, welcome. Thank you for your service and for your testimony today. Please proceed.
JP. Chairman Brown, Ranking Member Scott, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. The Federal Reserve remains squarely focused on our dual mandate to promote maximum employment and stable prices for the benefit of the American people. Over the past 2 years, the economy has made considerable progress toward the Fed's 2% inflation goal, and labor market conditions have cooled while remaining strong. Reflecting these developments, the risks to achieving our employment and inflation goals are coming into better balance. I will review the current economic situation before turning to monetary policy. Recent indicators suggest that the U.S. economy continues to expand at a solid pace. Gross domestic product growth appears to have moderated in the first half of this year, following impressive strength in the second half of last year. Private domestic demand remains robust, however, with slower but still solid increases in consumer spending. We have also seen moderate growth in capital spending and a pickup in residential investment so far this year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, a broad set of indicators suggests that conditions have returned to about where they stood on the eve of the pandemic, strong but not overheated. The unemployment rate has moved higher, but was still at a low level of 4.1% in June. Payroll gains averaged 222,000 per month in the first half of the year. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in labor force participation among individuals aged 25 to 54, so-called workers in their prime working years, and a strong pace of immigration. As a result, the jobs to workers gap is well down from its peak and now stands just a bit above its 2019 pre-pandemic level. Nominal wage growth has eased over the past year. The strong labor market has helped narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased notably over the past couple of years, but remains above the Federal Open Market Committee's longer-run goal of 2%. Total personal consumption expenditures prices rose 2.6% over the 12 months ending in May. Core PCE prices, which exclude the volatile food and energy categories, also increased 2.6%. After a lack of progress toward our 2% inflation objective in the early part of this year, the most recent monthly readings have shown modest further progress. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee has maintained the target range for the federal funds rate at 5.25% to 5.5% since last July, after having tightened the stance of monetary policy significantly over the previous year and a half. We've also continued to reduce our securities holdings. At our May meeting, we decided to slow the pace of balance sheet runoff starting in June, consistent with the plans released previously. A restrictive monetary policy stance is helping to bring demand and supply conditions into better balance and to put downward pressure on inflation. The committee has stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%.
NASDAQ markets dropping.
Incoming data for the first quarter of this year did not support such greater confidence. The most recent inflation readings, however, have shown some modest further progress, and more good data would strengthen our confidence that inflation is moving sustainably toward 2%. We continue to make decisions meeting by meeting. We know that reducing policy restraint too soon or too much could stall or even reverse the progress that we've seen on inflation. At the same time, in light of the progress we've made both in lowering inflation and in cooling the labor market over the past 2 years, elevated inflation is not the only risk we face.
Watch for support.
Reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering adjustments to the target range for the federal funds rate, the committee will continue its practice of carefully assessing incoming data and their implications for the evolving outlook, the balance of risks, and the appropriate path of monetary policy.
Jesus.
Congress has entrusted the Federal Reserve with operational independence that is needed to take a longer-term perspective in the pursuit of our dual mandate of maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well
NASDAQ dropping further.
Restoring price stability is essential to achieving
lower.
maximum employment and stable prices over the long run. Our success in delivering on those goals matters to all Americans. I'll conclude by emphasizing that we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission.
Reversal on
Thank you.
big
I look
tech.
forward to your questions.
Thank you, Mr. Chair. And the senior member of the committee will begin the questioning. Senator Reid.
Thank you very much, Mr. Chairman. Former President Trump has indicated that he would propose, if elected, a substantial increase in tariffs of between 10 and 60%, and by doing thus, eliminate the federal income tax. First, on the question of what would be the impact of tariff increases on prices, consumers, and the economy?
I don't think you'll comment.
Thank you, Senator Reid. So I'm going to say that we go very far out of our way not to comment on campaign type information. We just don't do that. We also don't comment on trade policy. We have really specific and important jobs, and we try to stick to those.
Well, I'm glad I allowed you to establish that principle up front, Mr. Chairman. But let me opine a bit. 10% increases in tariffs is going to have an effect on prices in the shop aisle. It's going to increase them because they'll be passed on likely. 60% tariff increases are significant. And in fact, I've been told that to replace the income tax, we would have to raise tariffs
100%.
across the board 70% to make up for the loss of the income tax, which would, I think, create huge economic problems. I respect your impartiality and your neutrality, but the numbers don't seem to add up to anything that would help the country. Let me switch to something else that might be more within your line of response. You said in your opening statement that labor markets appear to be in a better balance. And that's one of the key factors to judge whether interest rates can be raised. I must say I'm concerned a bit that we're not on a very faster track to decreasing interest rates from the Fed. And because of the better balance you cite. Could you comment on that, Mr. Chairman?
Sure. So the most recent labor market data do send, to your point, a pretty clear signal that labor market conditions have cooled considerably compared to where they were 2 years ago. This is no longer an overheated economy. This is an economy, as I mentioned in my opening remarks, that is more or less back by most measures to where it was before the pandemic. And that was a strong labor market, but it was not an overheated labor market. So I think the upshot of that really is that we're well aware that we now face two-sided risks and have for some time. But now the labor market appears to be fully back in balance.
Let's
we
move
know
back, boys.
that if we move too quickly, we risk unnecessarily hampering economic activity and possibly interfering with the ongoing expansion. We know that if we move too slowly, that we may undo the good we've done. Well, actually, it's the other way. If we loosen policy too late or too little, we could hurt economic activity. If we loosen policy too much or too soon, then we could undermine the progress on inflation. So we're very much balancing those two risks, and that's really the essence of what we're thinking about these days.
But the direction seems to be going towards lowering interest rates at some point, we would hope. That might be a wish rather than a direction.
But I think if you look at the last summary of economic projections, I guess I would say it this way. It doesn't seem likely that the next policy move would be a rate increase. We don't take things like that off the table, but that does not seem the likely direction. The likely direction does seem to be as we make more progress in inflation and as the labor market remains strong, we begin to loosen policy at the right moment.
Thank you. Just 2 weeks ago, the Supreme Court handed down 2 decisions that impact every federal regulatory agency, including the Federal Reserve. They overturned the Chevron case, which had eliminated judicial deference to agency decision-making for many, many decades. And they also dramatically extended the statute of limitations under the Administrative Procedure Act.
There we go, NASDAQ
What
market
is your
dropping.
judgment is the cumulative effect of these decisions on the Federal Reserve? More broadly, what does it mean to the economy if virtually any regulatory decision the Fed makes can be second-guessed by a judge? What position are we in now?
So we're as an institution very focused on reading the actual letter and intent of the law and following it carefully. This is a strong institutional value that we have.
Get ready.
Those are brand new decisions that just came down, and we're really in the process of just studying some. I don't have anything for you on them, but we will of course follow the law as the Supreme Court. As the Supreme Court has read it, because that's their job.
Well, thank you, and I concur with compliance with the law, but when you do your analysis, and if it is detrimental to your ability to regulate the banking industry in the United States, I think you have an obligation to make that public. Thank you, Mr. Chairman.
Thank you, Senator Scott from South Carolina is recognized.
Thank you, Mr. Chairman. Chair Powell, we've heard a steady stream of commentary that there will be changes to Basel III endgame proposal.
Watch for signs of support here on NASDAQ. Remember, markets are very bullish, so they could recover very quick. Just a heads up.
Today, you were circulating a term sheet for a revised proposal. Through it all, this proposal will have outsized impacts on our banking system, from big to regional to our U.S.-based foreign institutions, as well as impeding access to credit for consumers. So even though you yourself have said there will be broad and material changes, I believe this proposal is flawed, both in process and in substance, and should be withdrawn. Do you agree, and will you commit to withdrawing the existing proposal and issuing a new proposal with a robust notice and comment process?
Well, let me update everyone on the status of all that. So over the past several months, we've had, in fact, Vice Chair for Supervision Barr has held a series of discussions with the other bank regulatory agencies around potential changes to the original proposal. I'm pleased to say that we've made quite a bit of progress on those and are very close to agreeing on the substance of those changes. And I can't really be specific because nothing is agreed until everything's agreed, so I won't have a lot of specifics for you today. The question where we're continuing to try to make progress is that of process. So it is my view, it is the strongly held view of members of the board that we do need to put a revised proposal out for comment for some period. And the reason is, when there are broad and material changes, that has been our practice. We don't see a reason to deviate from that practice. It seems to be consistent with past practice and with the Administrative Procedure Act. So that's very much what we think, and we're working through that question with the FDIC and the OCC. We haven't reached agreement on that, but I'm very hopeful that we will. We're prepared to move forward when we do reach agreement on that.
Well, I appreciate most of your response there. I do want to discuss one aspect more of Basel before we move on to another topic. I find it very concerning with how much of this proposal, this process appears to have been done behind closed doors. The Fed, the FDIC, OCC proposed Basel III endgame last July. Then in October, the Fed began the collection of data to conduct a quantitative impact study on the cost of Basel III proposal, a study which I will note should have been conducted before any proposal was ever issued. Move forward to January of this year, Vice Chair Barr committed to a public comment period once results of the study were published. We are still waiting to view the results. Keep in mind, all the while, we're hearing rumors that the Fed is working on revising its proposal and moving towards an updated version. Please help me understand, how will the Fed revise or reissue a capital proposal before receiving public comments? Basically my question.
Well, as you know, we have received extensive public comments, and we've also evaluated the quantitative impact survey that you mentioned.
Yes.
And so the idea would be when we do reach agreement with the other agencies fully, that we would publish the proposed changes and also the quantitative impact survey, and also the effects that the QIS suggests that the changes would have. So we'll put all that out for comment again for a period of time, and then having had yet another round of comment, and we can then move toward finalizing. That's basically the broad strokes of how I would see this moving forward.
And how long do you see that opportunity for public comments?
So it would be meaningful. I mean, it might be 60 days. We don't need to it doesn't need to be a long one. But, before we do that, there's a lot of work that needs to take place before you actually put out the revised proposal, quite a bit of work. So it will take some time, and then we would put it out, and then there would be, I'm just taking that number, 60 days of comment, and then we would get the comments back, and there would be another period of evaluating the comments, and only then would you go final. So there are a number of steps here.
Yeah, thank you. Well, just final point as I'm running out of time here. I think Senator Reid made the comment about the Chevron case and the impact that it could have, certainly curtailing, from my perspective, the regulatory state. The necessity of a cost-benefit analysis on new regulations that will impact the economy, I think, is quite helpful. In the 1,000+ pages of Basel III, I think there were about 20 pages that reflected some kind of cost-benefit analysis approach. I really hope that we see more of that going forward.
Thank you.
Senator Tester from Montana is recognized.
Well, thank you, Mr. Chairman. Thank you for the courtesy. Chairman Powell, good to see you here today. Appreciate your work. Look, regardless of where I go in the state of Montana, housing is a big issue, whether it's Billings or Butte or Bozeman or Busby or Big Sandy, it doesn't matter. Larger towns to medium-sized towns to small towns, housing is a huge issue. And I think it's a huge issue all over the country, and correct me if I'm not correct in that. And I was wondering how the housing challenges fit into the overall economic picture that you're seeing.
So we do pay a lot of attention, and I would agree with you. We have significant housing issues in the country, and we had them before the pandemic. Certainly, the pandemic has created new distortions, and monetary policy works through interest-sensitive spending. There is no more interest-sensitive spending than buying a house and having a mortgage. So, for sure, our tighter policy is having an effect on economic activity in the housing sector. But I would also say the best thing we can do for housing is to succeed in getting inflation down to 2% on a sustainable basis, so that rates can come down, so that the housing market can get back to what was the pre-pandemic normal, which is to say still a housing shortage, but not dealing with the kinds of specific things we're dealing with now.
So let me drill down a little bit. I'm speaking not necessarily from a housing cost interest, and you're correct on the things you just brought up. I'm speaking more from a standpoint of economic growth, in that there are plenty of small businesses, schools, hospitals, Main Street businesses that can't hire people, they can't expand because there simply is no place for them to live. How does that fit into your economic outlook metrics? Because I think it's, from my perspective at least, I think it's limiting the opportunity for expansion. It's limiting the opportunity for entrepreneurs, just business startups. And does that fit into the economic picture that you look at?
So our mandate is for stable prices and maximum employment. And again, I think for housing supply, the best thing we can do is get inflation under control so that rates can come back down, so that we can have a more normalized set of rates and a more normalized housing system. But I think policies to increase housing supply are really not so much in the hands of the Fed, they're in the hands of legislatures, state and federal.
Do you believe that if we were to put forth some housing incentives, whatever they may be, that could have if those incentives resulted in more affordable workforce housing on the market, that would have positive impacts on the economy?
These are questions for you, but I would say this, that I'm aware that housing is in short supply, and that for many it's a critical need for the workforce. Okay. And so more of it is better, but as to where the fiscal policy how you should prioritize that's not up to us.
Look, I want to talk about the independence of the Fed for a second, because I know that you are a strong supporter of independence, as am I, and political influence I don't think helps with monetary policy in the country. And so give me your perspective at least on why the central bank independence is so critically important.
Thank you. I'd be glad to. So essentially all advanced economies have adopted a policy of central bank and operational independence. And that just means that we make our decisions, we're instructed to make them without taking in extraneous factors, one of which would be politics. And the record is pretty clear that that's a good it's a good institutional arrangement that serves the public well. And we just want to stress, as we do periodically, that this is an institutional choice that we make as a country, and that as long as it's seen to serve the public well, it's a good choice. We think so.
Okay, on advanced economies, there's some that talk about the economy of this country not being in very good shape. From your perspective, tell me how the economy of this country is doing compared to other advanced economies that have central banks.
So I'm in lots and lots of international discussions as part of my job, and the story for the last 2 years has been just how exceptional the performance of the U.S. economy has been, and that's not a secret. Clearly the U.S. economy has performed very well compared to sort of our advanced economy colleagues.
Is there any country in the world with a central bank, any advanced economy that's performing better?
Better as a central bank?
Any economy that's an advanced economy that has a central bank that performs better than us?
None comes to mind. As I think of the majors, the answer would be no.
Okay, thank you.
Thanks, Senator Tester. Senator Rounds of South Dakota is recognized.
Thank you, Mr. Chairman. Mr. Chairman, first of all, thanks for coming in again and visiting with us. I just want to focus on two specific items, and I'm going to start with the Basel III endgame discussion. I think Senator Scott did an excellent job of kind of laying out the concerns that many of us have had with it. I would like to go back into just one particular issue, which I think a lot of folks out there that follow this, and I know it's technical in nature, but let me just ask a specific question and you can kind of pick it apart for me, please. Both you and Vice Chair Barr have confirmed that there will be material changes to every risk type outlined in the proposal. Since there will be significant changes, do you believe where the agencies have landed now would be considered a logical outgrowth of the original proposal from last summer?
For those people who are not familiar with, that's the legal test that turns out to be if it's a logical outgrowth. If it's not a logical outgrowth, that would legally require a reproposal. And I don't want to make the legal judgment. I will just say again, from my standpoint, my view and strongly held view of some of my colleagues on the board is that it will be appropriate for us to put out the changes again for a period of comment, just because it's the right thing to do. It's what we would do typically in a situation where there are material changes to a proposed rule.
Do you feel that you have a consensus in the board to allow that to move forward in terms of an additional comment period?
Yes, but of course we have to get the FDIC and the OCC. We're in discussions with them to work on something that would meet that need, and we have to get their agreement too.
Assuming it sounds like that's the path that you would like to go down.
Yes.
If that were the case, would it be fair to say that we'd probably be looking at final determinations or recommendations for a Basel III endgame proposal probably into next year before it would become anything of a final determination?
I think that may be right. That's something like that could be right. Yeah. I mean, it's hard to be precise. We would put it out. It takes some time to write this stuff up. Then you put it out for comment, then you get the comments, then you read the comments, then you write the final rule. Beginning part of next year is a good guesstimate.
The only reason why I push is because there are so many folks directly involved with this and the impact on our economy here and with a lot of our financial institutions. This is a significant change, and it's one that a lot of people are following. So I'm trying to get you to get into the depth of this as much as possible, and I thank you for that. I'd also want to go into one other area, and once again, this is something that you and I have had visits about in front of this group before, but I want to talk about what the parts of inflation are and what parts you can control and what parts, as the Fed, you really can't control. The demand side of the equation on inflation is the part that you have the tools to work with. But there is the supply side of the equation, which is still out there. And I want to just lay this out because as we do this in this setting, it naturally becomes political in nature because one of the starting points that we talk about is when this administration took office and what happens with supply side issues at that time. And as I work my way through this, I just want to share the concern that I've got. And then I recognize you don't want to be political in it, but I want to lay this out, and then I want to talk about what you can control and what you can't control with regard to making changes on inflation through the processes that you have. When President Biden took office, gasoline prices, since President Biden took office, gasoline prices have risen over 54%. Energy prices have risen 41%. Fuel oil prices have risen 37%. Now, I can go on and on, but you understand what I'm saying is that energy has increased substantially. And I think one of the reasons for this has been additional demand as we've come out of a pandemic. But the other part of this has been whether or not investors really want to go back in and invest in traditional energy resources after the president made the specific determination to cancel the Keystone XL pipeline on the day that he stepped into office. When he did that, he sent one heck of a message to investors about traditional energy and investing in traditional energy in the United States, and the fact that a multi-billion-dollar contract or contract could be canceled with the stroke of a pen. Now, my question to you is, what percent, or has there been a discussion about what percent or what amount of the inflation that we've seen, over 20% increase in terms of affordability for a lot of our products, how much of that is attributable to the demand side and how much of it really is attributable to supply side challenges that we've seen in this country?
It's that's a question that we've thought about a lot, and any attempt to reduce that to a precise number would be inappropriate because it's so uncertain. But I think we can say, I believe strongly, there's a significant demand element and there's a significant supply element. And we've seen the supply side heal so much over the course of the last year or so, and we clearly see that that's contributing to lower inflation. We also see cooling demand, for example, in the labor market. So the two forces are working together. I can't really break it down. It would be such an imprecise estimate.
Just simply an acknowledgement, though, that it is both demand.
It's both. It's definitely
and
both.
it is supply.
It is both. Yeah, for sure.
Thank you, Mr. Chairman. My time has expired.
Chair Powell, unemployment has risen by 0.5 percentage point over the past year. The number of job openings.
I don't know if it's just me, but I'm being bored to death with all of these BS questions.
I'm concerned that if the Fed waits too long to lower rates, the Fed.
I'm going to be closing out the live stream. I don't want to bore you guys to death, especially when we have a very significant live stream that's going to be this Thursday, and it's the CPI data report. I'm so sorry. If I'm falling asleep, I can only imagine how you guys feel. If you guys want to continue to watch it, it's on the Federal Reserve website. But as of right now, the market's not moving too significantly. I would encourage, if you're a beginner, to wait for this meeting to be over, to wait for the market to react, to see if it reacts in a positive or negative way, to better determine and to not be caught on the bad side of a trade. Just like we talked about it in our live trading session today with the LPP team, is anytime that Jerome Powell speaks or anything like that comes out, there could be quick changes of direction that you would have not been able to predict. So again, instead of trying to predict the future, all we need to do is be aware and prep. So knowing that market can quickly sell off just like it did or quickly begin to recover is something that we cannot think can't happen, okay? So if you're someone that doesn't deal well with volatility, maybe today is not a day to potentially force any trades. I hope to see you for our CPI data report this Thursday, and all I literally ask you to do is drop a thumbs up and subscribe to my channel. I'm going to be going live 1 hour before the market opens. That's when the CPI data report comes out. For those that are unaware, I can promise you it's much more interesting to watch the market react to that CPI data report than it is to hear these old men speak. And Jerome Powell, in my opinion, he's very well spoken. He does not talk about things he's not supposed to. Some of you guys like him, some of you guys don't. I think that he does his job great in the sense that he tries to not give a biased opinion regardless of whatever the politician is trying to encourage him to comment on, which I don't feel like the average person would have the restraint to do. That being said, again, market direction isn't super clear right now. So let's stay cool, calm, and collected, save those day trades, and then when direction becomes more clear, let's go ahead and, choose to strike when it makes sense and when direction is clear. I'll see you for the CPI data report this Thursday, and that's going to be 1 hour before the market opens. Make sure you drop a thumbs up. Make sure you subscribe. And don't forget, if you want to be able to tune on into our live trading sessions, that's going to be that second link in the description down below. And also a quick little heads up, if you guys haven't joined our quick little trade tracker, for those that are not familiar with it, we track all of politicians' trades. We just sent out another email. We send it out every Monday. So all you have to do is, I think it's the first link in the description down below. It's just under techbuttsolutions.com under trade tracker. You enter your email and we send you a weekly newsletter, just keeping you up to date on what trades politicians are taking. And if Nancy Pelosi takes any trade, we do send a random email based off of her announcement of her trade, because it's not always every Monday. So I appreciate your time. Hope that we're in a thumbs up. If you guys have any questions, feel free to reach out or either comment down below. And again, everything that we talked about is linked in the description of this video. Like always, let's make sure that we end the year on a